Welcome back to this week's Lucia Capital Group video. I'm Rick Plum. So have you thought recently about selling your home? If so, you might be selling at a good time. The Case-Shiller U.S. National Home Price Index tells us that the average price of homes across the country has gone up by about 56% since its most recent low back in February of 2012. For some people in certain housing markets, that adds up to a lot of gain, especially if you owned it as your primary home for the past 7 years or more. But you might also be concerned that you'll have to pay a bunch of taxes when you sell because your home has gone up so much in value. Well, I may have some good news for you. You may be able to keep most, if not all, of the money you get from the sale of that home. This is because of Section 121 of the tax code. This allows you to exclude up to $250,000 of capital gain from the sale of your home, or up to $500,000 of gain if you file a joint return with your spouse. Of course, like anything else in taxes, you have to follow some rules and meet certain standards. To qualify, it must be your primary residence, so it can't be an investment or vacation property. You also must have owned and occupied the home as your primary residence for at least 2 of the last 5 years, or more accurately, 24 months out of the last 60 months. That's before you sell it. That's known as the use test and the ownership test. In some cases, you can get a portion of that gain tax-free even if you don't meet the 24-month rule, but those are exceptions. And by the way, the 2 years of residency and the 2 years of ownership, they don't even have to be concurrent. Maybe you rented it from the previous owner for a couple years before buying it. If so, that can still work. And you can only use this exclusion on one home in any 24-month period of time. So as long as you haven't used this exclusion on another home within 2 years prior to the sale, you may qualify. I said earlier that a married couple can qualify for an exclusion of up to $500,000 on one home. In order to do that, you have to show that all of the following are true. You're married and file a joint return for the year of sale. Either you or your spouse meet the ownership test. Both you and your spouse must meet the use test. And during the 2-year period prior to sale, neither of you have excluded the gain from the sale of another primary residence. Now remember, just because you can exclude some or all of the gain on your house doesn't mean you don't have to account for it on your tax return. If your real estate closing agent issued you a 1099-S, then you'll need to show the IRS on your tax return why you're excluding that amount. It's kind of a hassle, but you'll need to do it. So it may save you some time if you can prove to your agent, this is with documentation, that you don't owe taxes on the gain, and therefore they won't send you a 1099-S. Either way, this is one of the best tax breaks out there. So if you qualify, be sure to take advantage of it. If you need help in figuring it all out, just give us a call and we'll get it done.